I think what's interesting about this year, in terms of being different from last year, is market leadership has actually broadened quite a bit. So yes, technology and mega cap tech has continued to do well, but we've actually seen some other sectors, including areas like healthcare and energy, and into media as well late in the quarter, start to perform quite well. So second quarter was a good quarter for growth, for the market in general, but I think what we're starting to see that's encouraging is that market leadership is certainly becoming more broad, and some of the sectors where valuations had gotten unsustainably low starting to re-rate higher, and some stocks starting to kick in areas like energy and healthcare. I think second quarter across the board was pretty good. Growth did well. Our portfolio certainly participated in the upside. Again, encouragingly, what was different about this quarter versus the previous quarter and last year is slightly different looking leadership. Even though oil prices retrenched late in the quarter, energy equities, particularly the E&P companies, continued to do quite well. A number of the public companies that we own are up 25 to 30% this year, even with oil prices in the U.S. only up 9 to 10%. We're high active share managers for the long term, and we own a lot of the businesses today in the portfolio that we've owned for decades in some cases. So when you see an uptick in volatility, what it allows us to do is take advantage of those periods of dislocations in the market. So certainly look at the long term, certainly look at taking much more of an investor's approach versus a trader's approach. But when you get these periods where the market acts more irrationally and volatility clearly upticking this year, it gives us the chance to take advantage of that, to take some profits, to redeploy some of the cash. You know, early February, the VIX went from 10 to 50, which is an extreme move. And so trying to be on the other side of some of those trades allows us to manage the investor portfolios. When there's no volatility, like 2017, the VIX on average was about 11, which is extremely low relative to history. There's not going to be as much trading activity in the portfolio. We're now 10 years into a bull market, very likely to see a very different market environment for the next 3 to 5 years than we've had for the last 3 years. In some cases, valuations of the very expensive names haven't mattered. In other words, the momentum stocks have continued higher. What that's left in its wake is certain sectors, even though they've started to do better, like energy, media, and healthcare, I believe becoming the new leaders. I think in an environment where you see more consolidation, you see not only a broadening of leadership, but you actually see a bit of a shift in terms of leadership. I think the M&A theme could really cause very different looking market leadership, where some of these undervalued growers, some of these very dramatically cheap stocks on a multiple basis, start to become the leadership. So I think that the next 3 to 5 years, you're going to start to normalize some of these valuation discrepancies, where some of the very high multiple names, particularly in the NASDAQ, can come back to earth, and some of the stocks which essentially got inappropriately cheap on the downside can start to re-rate higher.